Okay, so Brighter with Herbert just posted that Tesla's launching a live Cybercab next week, and everyone's acting like the stock's about to 10x tomorrow. Here's the thing though, there's a massive gap between we're showing you a car and we're making money off a car. And that gap is where most retail investors are about to get confused. Tesla stock is down 1.26% today, sitting at 345.82. The broader market barely moved. S&P 500 flat. But the real signal isn't in today's price action. It's in what launch next week actually means for the cash flow story. Because here's what we know. Brighter with Herbert is hyping it. Holmar's catalog's been running self-driving footage that does 2 to 12 times their channel median engagement. The narrative is hot, the hype is real, but there's no production timeline, no pricing, no volume commitments, nothing that actually moves earnings. This is a demo, a very good demo, probably. But a demo. Tesla made roughly $25 billion last year. About $21 billion of that came from selling cars. Energy is growing, but it's still a rounding error compared to car sales. Now, if Cybercab actually scales, if it becomes a Robotaxi network that generates subscription revenue, that changes the unit economics entirely. But here's where retail investors miss the second-order play. If Cybercab takes off, it cannibalizes Tesla's core margin driver. Car sales. Fewer people buy Teslas if they're just hailing a Cybercab on demand. You're not selling 1.8 million vehicles a year anymore. You're selling 10,000 Cybercabs into a fleet, and you're keeping the margin as a software play instead of a hardware play. That's not a bad outcome. It's actually potentially a better outcome. But it's a totally different business. And the market hasn't priced that in yet, because it doesn't exist yet. Morgan Stanley didn't just watch a Tesla Robotaxi demo and start pricing in a $100 billion business line out of thin air. They read the cash flow implications. They understood the margin trade-offs. That's why the stock didn't explode yesterday, because Wall Street knows the difference between a prototype and a production ramp. Brighter with Herbert and Holmar's catalog are right that this is coming. The tech is real. The narrative is real. But coming and generating revenue are not the same sentence. Look back at the history. Tesla announced the Semi in 2017. First customer delivery was 2022. 5 years. Cybertruck was announced in 2019. Meaningful volume just started this year. That's the actual timeline we should be modeling. So here's what retail investors are actually positioned for. You're not betting on next week's demo. You're betting on whether Tesla can execute a full pivot from a car company to a transportation services company over the next 3 to 5 years. That's the real thesis. And if you're already holding Tesla, you're already making that bet whether you know it or not. The demo is the headline, the cash flow story is the actual bet. So here's my question for you. Are you holding Tesla because you think the Cybercab is shipping at scale in 2 years? Or are you holding it for the automotive margin through 2027? Because those are very different portfolios. Drop a comment and let me know what you're actually positioned for. And if you want the full picture on how Tesla's other bets are shaping up, I went deep on Morgan Stanley's actual thesis in another video. Link in the description. And speaking of robots reshaping timelines, the world's fastest humanoid robot just hit speeds faster than Usain Bolt's top velocity. We're talking sub-6 second 100-meter pace, which is hilarious because Tesla's still talking about the Optimus being ready in a few years, and now a competitor's already outrunning Olympic sprinters. The future's weird. All right, if this kind of second-order thinking is useful to you, stick around. More coming. Later.